Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BRETON interim report. The significant increase in BRETON Technology Co. Ltd's stock price over the past year can be attributed to several key events. The company's filing for a Hong Kong IPO in November 2024, which highlighted its strong growth prospects in the green technology sector, contributed to the upward trend. Additionally, its inclusion in the Hong Kong Stock Connect program and the S&P Global BMI Index in September 2025 further boosted demand for the stock. Furthermore, the company's announcement of a 22.2% year-on-year increase in revenue to 327 million yuan in August 2025, despite widening losses, was viewed positively by investors as a signal of potential future profitability and market share expansion. These developments have collectively driven up investor confidence and contributed to the stock's substantial growth over the past year. The primary drivers of revenue growth for the company are largely attributed to the increasing demand for battery-electric wide-body dump trucks, spare parts and accessories, and rental income. The sales of these products have seen significant increases, with battery-electric wide-body dump trucks experiencing a 77.5% increase in sales. Additionally, the expansion of overseas business, direct sales to key customers, and the development of new products such as autonomous driving equipment have also contributed to revenue growth. On the other hand, the primary drivers of revenue decline are mainly due to decreases in battery-electric loader sales, which saw a 51.1% decrease. The company's exposure to individual customers with significant concentrations of credit risk has also led to revenue decline. Furthermore, the loss patterns of different customer groups and ownership background have contributed to this trend. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes, particularly in net income and profit margins. Despite a slight decrease in net income by 0.1%, the gross profit margin has seen a substantial increase of 3.3 percentage points, rising from 3.1% to 6.4%. This improvement in profit margins suggests that the company's ability to generate revenue from sales has improved, offsetting the minor decline in net income. The reasons behind this shift are not explicitly stated, but it is likely due to various operational and strategic changes implemented by the company. The company's financial performance indicates a concerning trend. Despite its efforts, the business is struggling to generate positive operating cash flow. According to the financial summary, the company has consistently reported negative operating cash flow across various pages, 12, 15, 35, 41, and 47. This suggests that the company's expenses are exceeding its revenues, resulting in a net outflow of cash from operations. As a result, the company is facing significant challenges in maintaining its financial stability. The company's debt level and interest expenses have undergone significant changes. While the total debt decreased by 46.6%, the total borrowings increased by 47%. This indicates a shift in the company's financial structure, with more borrowing taking place despite a reduction in overall debt. Furthermore, interest expenses on loans and borrowings saw a substantial increase of 54% from 2024 to 2025, reaching RMB 6,123,949. This rise in finance costs is likely due to the increased borrowing, making it essential for the company to manage its financial obligations effectively. Management's outlook on company strategy. The company plans to expand its PV storage and charging energy business globally. This international expansion is expected to drive increased investments, which will be financed through a combination of bank borrowings, equity financing, and other sources. The company's financial activities involved several key transactions. On the acquisition side, the company issued H shares through an initial public offering, raising a significant amount of capital. Additionally, it acquired bank acceptance bills with a carrying value of RMB 29,938,384. In terms of divestitures, the company sold endorsed bank acceptance bills with a carrying value of RMB 35,492,208, resulting in a net loss from these transactions. It also disposed of unlisted equity securities for $500,000. The company's financial summary reveals a notable trend in its capital management strategy. Specifically, the company has engaged in share buybacks, as explicitly stated on page 62 of the extracted summaries. In contrast, there is no evidence to suggest that the company has distributed dividends to its shareholders. This suggests that the company has chosen to retain earnings and reduce its outstanding share count through repurchases rather than providing returns to investors through dividend payments. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights several red flags that suggest potential issues with inventory management. A significant increase in raw materials inventory by 8% indicates a possible accumulation of stock, which can lead to supply chain disruptions if not managed properly. Furthermore, the write-down of inventories increased by 15%, suggesting that the company may be struggling to sell or utilize its existing stock efficiently. The presence of prepayments for the purchase of raw materials also raises concerns about inventory buildup. If these prepayments are not utilized effectively, they can result in unnecessary costs and potential losses if the materials become obsolete or cannot be sold at a reasonable price. Overall, these indicators suggest that the company needs to reassess its inventory management strategies to avoid supply chain disruptions and minimize financial losses. That concludes the financial summary for BRETON. Feel free to comment below, and I will be happy to answer them when possible.